Welcome to this explainer. Okay, we've got a seriously wild week to untangle in the global markets. We're going to make sense of all the noise by tracing this fascinating real-time domino effect. Over the past few days, we've seen shifts that completely defy traditional market logic. By the end of our time together, you're going to understand exactly how global geopolitics, central bank policies, and algorithmic trading all violently collided at once.
Let's just dive right into this massive contradiction that literally has everyone scratching their heads. Right now, on the exact same days of trading, we are watching highly speculative assets absolutely capitulate, just shedding billions in value. But simultaneously, US tech indices are actively hitting record highs. It's honestly wonderfully ironic, right? The supposedly decentralized assets are collapsing, while the centralized megatech giants are absolutely thriving. Normally, the market moves as a herd. It's either a risk-on party where everything rallies or a risk-off panic where everything bleeds. But today, the market is completely fractured.
To understand the chaos, we have to trace the dominoes all the way back to the macro triggers. It always starts with the foundation, and in this case, it's energy. The initial shockwave kicked off last week with escalating tensions between the US and Iran. Following a cargo ship strike, retaliatory strikes over the weekend raised some serious red flags about the stability of the Strait of Hormuz, which is a massive, absolutely crucial artery for global energy. And the immediate result? Monday's market reaction saw Brent crude oil spike to $73.44 per barrel. But, this wasn't just an energy story. It instantly became an inflation story. That spike in oil prices instantly reignited global inflation fears, and that forced the hand of the new Federal Reserve Chair, Kevin Warsh. During his highly anticipated press conference, he didn't mince words, at all. He made his priority crystal clear, stating the committee's unanimous and unambiguous commitment to fighting inflation. Actually, he mentioned price stability 12 separate times. For investors listening, this wasn't just a casual update. It was a blaring alarm bell signaling that interest rates might not be coming down anytime soon. And this illustrates the massive whiplash we just witnessed. Coming into the year, the market was super comfortable, expecting 1 to 2 rate cuts, guided by clear communication from the Fed. That was the old reality. The new reality? Thanks to the energy spike and Warsh's firm stance, we're suddenly looking at expectations for 1 to 2 rate hikes this year. And worse yet for traders, Warsh essentially killed traditional forward guidance, meaning the market is suddenly flying blind. The era of easy money expectations? Yeah, that's officially on pause, and traders were caught entirely off guard. So this sudden hawkish pivot triggered a completely bizarre divergence across asset classes. The ripple effect is wild. Oil is up, signaling inflation. Volatility in emerging markets like India is up, signaling intense caution. But then, look at how specific assets are behaving. Bitcoin is facing brutal capitulation downward, while the US 100 tech index is just defying gravity and charging upward. Let's break down exactly why these assets reacted so differently to the exact same macro news. Moving on to Bitcoin's brutal summer crash, falling below $60,000. Let's look at this first major domino to fall, which is the most speculative asset on the board. It just plummeted below that critical 60K mark. To put that into perspective, that is a massive 53% drop from its all-time high of over $126,000 back in October 2025. It's the lowest level we've seen since late 2024. But why did it fall so hard so fast? Well, it wasn't just a simple reaction to the Fed. It was actually 4 distinct pressures converging all at once to crush institutional conviction. First, an initial sell-off in highly speculative semiconductor stocks really spooked the broader risk-on market. Second, we saw massive ETF outflows. Third, MicroStrategy, a huge corporate holder of Bitcoin, disclosed a really rare sale of their holdings, which heavily damaged sentiment. And fourth, news broke about delays to the U.S. Clarity Act, that long-awaited regulatory framework for crypto. Literally all 4 hit at the exact same time. The sheer scale of the selling pressure here is absolutely staggering. $6.4 billion. That's how much money exited Bitcoin ETFs over the past month alone. And remember, when ETF holders want out, fund issuers are mathematically forced to sell the underlying Bitcoin to pay them back, regardless of what the current price is. It creates this ruthless cycle of forced selling that totally bypasses normal market sentiment. And things got even uglier because of a structural dynamic called short gamma. When you combine those massive ETF outflows with over $1.2 billion in put options clustered right at the $60,000 mark, you trigger an algorithmic trap. As the price drops closer to 60K, options market makers are forced to mechanically sell spot Bitcoin to hedge their own risk. It's a total snowball effect. The faster it falls, the more they have to sell, accelerating the crash in spectacular fashion. Now, looking at how volatility hits Indian markets as equities bleed. While the crypto markets were liquidating, the geopolitical shockwaves tipped over the next domino in the East. Driven by those exact same macro fears of inflation and Middle East instability, Indian markets saw a massive wave of investors just pulling their cash to the sidelines. The India VIX, which is basically the fear gauge for the domestic market, shot up over 4%. Because of that, the benchmark Sensex dropped by over 370 points, and the Nifty 50 slipped below the psychological 24,000 mark. Traders were actively hedging against near-term uncertainty and just waiting out the global storm. Which brings us to the surprising tech and corporate resilience, the anomalies. Just when you think the whole board is collapsing, we zoom out and find the assets completely defying gravity. Despite the global chaos, despite the Fed basically threatening rate hikes, and despite oil climbing, the US 100 Tech Index actually surged by 2.25%. It hit an astounding 29,751 points. What this tells us is that investors are still aggressively treating mega-cap technology and AI-driven companies as structural safe havens. They're not viewing them as speculative risks anymore. They're viewing them as the foundational infrastructure of the future economy. And this resilience spills right over into the corporate world, where massive strategic maneuvers are just marching forward without skipping a single beat. Persistent Systems pushed through a massive €1.27 billion all-cash acquisition of the German digital engineering firm Nagarro to build an AI powerhouse. Over in India, state-owned power financiers REC and PFC approved a historic merger to create a massive 11 lakh crore loan book entity. And at Kotak Mahindra Bank, major leadership transitions were announced with CEO Ashok Vaswani stepping down. It really exposes a profound split in the modern financial ecosystem. While highly leveraged traders are panicking at the very first sign of a Fed rate hike or a geopolitical headline, foundational corporate strategy and tech resilience remain entirely unfazed. The real business of building infrastructure, consolidating power, and investing in AI is operating on a multi-year horizon. It's completely divorced from week-to-week market fear. As we wrap up this explainer, here's what you need to keep in mind as you watch the markets this week. We've seen exactly how interconnected the system really is, how a ship in the Strait of Hormuz can ultimately trigger an algorithmic sell-off in Bitcoin. Right now, global markets are hinging on a fragile interim ceasefire between the US and Iran. If that ceasefire holds, we might see the pressure ease up. But if it breaks and oil spikes even further, what falls when the next domino is tipped? Thank you so much for learning with me today. Keep your eyes on the data, and we'll see you in the next explainer.